Hello everyone, welcome to the channel of Qianmo. In this video, we will talk about inventory and the year-end adjustments required for inventory account when we are working on the financial reports for clients and businesses. Inventory or stock is the goods and materials that a business holds for the goal of sale. Many businesses, especially in industries like manufacturing, wholesale, or retail, keep large quantity of inventory. Having an effective and efficient inventory system is so important for those businesses that inventory management itself forms a discipline, and some of the companies providing consulting services provide consulting on inventory as well. While inventory system takes into consideration of various aspects, including the process of ordering, storing, warehousing, sale, IT system, etc. In accounting, there are two different inventory systems. One is perpetual system, and the other one is periodic system. I'm sure we've learned them in a university or college. Today, we will talk about how they look like in our work practice. In perpetual, or referred to as continuous inventory system, inventory quantity and availability is updated on a continuous basis as a function of doing business. How does this reflect in the bookkeeping and accounts? Let's say company Toys Pizza Limited purchased $50,000 worth of inventory. In perpetual system, this purchase is recorded in the inventory account, which is an asset account that shows up on the balance sheet. 30 days later, those assets are sold. Then it goes out of the inventory account and recorded to the cost of goods sold account, which is an expense account that shows up on the P&L statement. So as long as no errors are made, the balance of the inventory account represents exactly how much inventory is kept in the warehouse of the business at any point of time. And the cost of goods sold account reflects the correct cost of the inventory sold as well at any given period. Different to perpetual system, periodic inventory system does not update the inventory account for each purchase and each sale. Instead, a purchase account is created under the expense account category, and all purchases are recorded to this purchase account. At the end of the financial year, a stock take is conducted to count the physical inventory, and then adjust the relevant accounts to reflect the correct value of the inventory left on the balance sheet and the correct value of the cost of the inventory that are sold that shows on the P&L statement. Therefore, when using the periodic inventory system, as an accountant working on the year-end financial report, the following adjustments are performed for inventory and the cost of goods sold. At the beginning of the financial year, credit the asset account inventory, the amount of the opening balance. Now the inventory account becomes zero. Then we debit this amount to the opening stock, which is an expense account. At the end of the financial year, when the stock take provides the correct value of the physical inventory, we debit this amount to the inventory account and credit closing stock, which is an expense account as well. By performing those adjustment entries, the inventory on the balance sheet reflects the physical inventory as at the year end, whereas on the P&L statement, the summary of opening stock, purchase, and closing stock represents the correct cost of goods sold during the given period. In work practice, in fact, periodic system is used much more frequently than perpetual system, especially for small and medium-sized businesses, because perpetual system consumes much more time to maintain than periodic system. So the above adjustment entries are conducted very often when we are doing our work in accounting firms. However, there are indeed some businesses use perpetual system, so it is important for us to know the reason why we perform those adjustment entries. For a new client that you are not familiar with and not sure what inventory system they've adopted, we do need to check the bookkeeping of the inventory account to determine whether the above adjusting entries are required. When perpetual system is used, it doesn't mean that no adjustment is required at all, as there could be errors, inventory being stolen or become obsolete that are not recognized. So a stock take as well as adjustments for those overlooked areas are also very important. Even though periodic system is used more widely among businesses, it doesn't provide the most updated inventory information and accounting for cost of goods sold. This means higher-level executives don't receive updated information about this very important area of the business. However, in recent years, technology is marching into almost all parts of businesses. So it is possible that as technology making timely update on inventory become much easier, more businesses would start to adopt perpetual system. Okay, that's all for today. Hope this video is helpful to you. See you next time.